Opendoor has been a highly volatile stock since recent months, and investors have been asking me to change my recommendation and update my recommendation very frequently on this stock, given the rapid price movements and changes in valuation. I had this stock rated as a buy way back in February before the market caught on to the undervaluation of this business. And since then, this stock price has soared to astronomical levels when measuring by the percentage improvement since February. So investors are asking me now, what should they do with Opendoor stock? Is it still a buy? Do I think it's a hold? Do I think people should sell? Let me provide you an update here in this video. I'll share with you my proprietary discounted cash flow valuation. I'll share with you some of the latest developments in macroeconomic terms and how it benefits Opendoor and some of the factors that are hurting Opendoor stock. And I'll share all those details with you and update my recommendation for Opendoor stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I updated my Opendoor stock valuation today, and the intrinsic value per share increased to $2.22 compared to the current market price now, which has soared to over $6. Even after today's price action, it's down 8.3%. The 52-week high is $7.32. The 52-week low is 51 cents. So this stock price has been very volatile. It has a really high beta of 3.09. And what this means is if the S&P 500 index moves up by 1%, Opendoor stock on average moves up by 3%. So it's 3 times as volatile as the S&P 500 index in both directions. If the S&P 500 moves down, then Opendoor stock moves down by 3 times as much also. So it's a 3x volatility compared to the S&P 500 index. And I've talked about this stock as not being for those who are risk averse. This should be only considered for investors who are seeking high return potential, but are willing to tolerate higher risk. So what are some of the factors that have impacted Opendoor stock lately? Now, I'm going to talk about fundamental factors, right? As you know, this channel is about fundamentals, the business, revenue growth, cash flow, those types of situations. I don't get into all of the hype and momentum and enthusiasm and the meme stock frenzy that happens around companies. I ignore all of that stuff. I just look at a business based on valuation. I don't like to play musical chairs and have a company and holding on to it based on the fact that I think I'm going to be able to sell it to somebody else for a higher price, and I'm holding on to it, and all of a sudden the music stops and there isn't enough chairs to sit, and I'm holding on to something that crashes by 95%, as I've seen happen with so many other situations with meme stocks and other types of things, and people lose so much money. It's so unfortunate. I've seen so many students at university where I teach come up to me and say how much money they lost with AMC stock and GameStop, and how they were tricked almost into thinking that these were sure things and they were going to only go up in value and there was no chance that they would go down. And what makes it even more painful is not only did they purchase these stocks for themselves, but they went around telling all their friends and family and coworkers and everyone about how good of an investment it is. And then when the prices crashed, not only did they lose their money, but they also kind of felt so bad about telling everyone else about these stocks without really having a basis for thinking these investments would go up in value, other than the fact that they're popular and it's a meme stock and there's momentum surrounding the business. So I ignore all of those things. I don't get involved with that stuff. I just look at the business on fundamentals and make my decisions based on those factors. And sometimes it works, sometimes it doesn't. There are no sure things when making investments, and I caution everyone viewing to take that same approach, to do your own due diligence. Don't look at a business based on just the share price movements up and down. Underlying every share price is a business, and you want to look at the business on its fundamentals. And so Opendoor, if you don't already know, it buys and sells houses, and it makes a margin for its service, right? So a lot of people complain that Opendoor lowballs homeowners and gives them lowball prices to sell their house to Opendoor. And then Opendoor does whatever marketing and fixing up that's needed to prepare the house and then sells the house for a higher price. So what it basically offers homeowners is convenience. Some people don't like that whole process of selling their home and all of the steps and inconveniences and all of the risk that's involved with putting your home up for sale. So people are choosing Opendoor. What are the factors that are impacting the business recently? Well, home prices have been unaffordable for most folks in the United States. Home prices have increased by rates that are much faster than their wages and wealth have increased. So the housing market is kind of stale right now between buyers and sellers. Sellers have embedded lower interest rates, so they don't want to sell their homes and lose that low interest rate. Buyers don't want to buy a house and pay these higher interest rates and pay high prices. Prices for homes are near record highs. Opendoor's management team is expecting a slowdown, and they've prepared for it. They're buying fewer homes, and the homes they are buying, they're lowballing even more than usual to give themselves a larger margin of safety. So one thing that's been a positive in recent weeks for Opendoor is a macroeconomic slowdown. You've seen me report on the jobs numbers in the United States, how we're generating fewer job growth, and that's making it more likely that the Federal Reserve cuts interest rates. If the Federal Reserve cuts interest rates, that will lower the mortgage rates people pay when they go to buy houses. And so there will be more interested in buying houses, and it can unlock more demand from home buyers to buy houses, which could create more interest in the housing market, which of course would be positive for Opendoor. And that's been a big positive. Interest rates are a big factor in Opendoor's business model. The lower the interest rates, the better for Opendoor, and interest rates have been moving significantly lower. The 10-year yield is now down to 4.05%, 4.06%. It wasn't too long ago where the 10-year yield was at 4.5%. That's a big slowdown, decrease in interest rates, and that makes home buying more attractive. So that's been good news for Opendoor. So what does that mean for my rating on the stock? Do I think it's time to buy this business? I say no, just because the valuation has increased by so much already. Investors have anticipated this upward move. The current market price at $6.20 is too high for me, given its relation to its intrinsic value and investor enthusiasm. I think is overdone. So I think if you've owned Opendoor stock and you've benefited from this rally higher, I think it's a great time to take profits, to sell some of your stake, if not all of your stake, and capture those gains. And perhaps if you're interested in the long-term benefits of the company, you can re-enter if prices move lower. So to update my recommendation, I had placed the company rated as a hold after the huge share price increase. Remember, I had it rated as a buy in February. And then when the stock soared to around $5 a share a little while ago, a few months ago, I downgraded the stock to a hold because the valuation had increased by so much. And that's the same reasoning behind my hold rating today, is due to valuation. I acknowledge the prospects have improved since interest rates are decreasing, but the price has also increased by a much larger magnitude. So I'm placing this stock rated as a hold. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.